Good morning and welcome to the 8th Annual General Meeting of Cadence Capital Limited. Thank you for your attendance and for your support. We also warmly welcome new shareholders who are joining us for the first time. And there are a lot of new shareholders. Our shareholder base has gone from 1,000 shareholders to 3,000 shareholders over the last 18 months, and that number looks to be growing at the moment as well. We've started to track how our shareholders are growing and what they look like, and I'll go into that in a bit of detail later. My name is Carl Siegling. I'm Chairman of the Board of Directors, and I will be chairing the meeting today. I would like to introduce James Churnside, who's not here, but he will be here, Wayne Davies, and Mr. Ronald Hancock, and the other members of the board. For people that haven't met Ron Hancock before, Ron was the former chairman and large shareholder in Wide Bay Building Society. We're very pleased to have him on the board. And from my point of view, when people ask me about Ron, I always say, look, Ron started Wide Bay a long time ago, and he's built a business from scratch and built it into a very, very big and successful business. What do we, as a group of managers and board members, need? We need someone who's been through that experience before and can guide us as we grow. And we see that those are attributes in Ron, and we're very pleased to have him on the board. Thanks, Ron. We've also got today all the members of the investment team, Chris Garrard and Simon Benouvre, who's joined us from Platypus, and Michelle Morgan has joined us and is now doing all the marketing and investor relations for our business. As it's grown, that's become more of a critical issue. Especially philosophically, we want to be able to get all of our shareholders as much information as possible via newsletters, webcasts, and any other information we can get to our shareholders we see as very important. We'll come on to that in a while, actually.
Carl, seeing she's looking out for shareholders, could I ask her whether she can close them?
Sorry, Michelle. It's okay. I can't hear that, but that's pretty noisy, yeah. And we've got our auditors here with us today, Scott Woodett from Moore Stephens. And many of you would have, I'm sure, seen Scott before. Scott's been doing our accounts now for 10 years at the end of this month. So it's not for the unlisted vehicle and 8 years for the listed vehicle. The first slide is the slide that I hope that everyone in this room and everyone that's a shareholder in our fund sees on a monthly basis. If there's anyone here that is not getting our monthly newsletter, please go onto the website and click to join to get the monthly newsletter. We also do a quarterly webcast, and we're very, very keen for people to know how we invest the money, the process, the shares that are in our portfolio. We try to be as transparent as possible with our shareholders on what we're doing, and we hope that everyone is receiving this newsletter. That bottom slide shows our exposure to the Australian stock market. The straight blue line shows what a traditional fund manager would be doing. They're mandated to be 100% net long at all times and are allowed to maybe hold 5% cash. And their world consists of holding stocks when the market's going up and holding stocks when the market's going down. They have no choice in the matter. Someone else is deciding for them that they're going to get a mandate to invest in resources stocks. They get that mandate, and their job then is to make as much money as they can or lose as little money as they can. And if they lose 35% in a year, when the resource index is down 45%, they've had a great year. We don't think that's a great year for the client who's down 35%, but that is really how. Of the $1.5 trillion of superannuation money in Australia, 900 billion of it is managed that way. We move between being invested when the market's up to cash when the market's performing poorly and getting reinvested again. We can also opportunistically short stocks. The net result of all of that over the past 10 years, this is the listed vehicle, so it's a graphical representation of 8 years, is that on average we hold 24 to 25% cash. We're a manager that moves between being invested in equities, being out of equities, and selectively choosing stocks. It's what we call an open mandate. The second slide is also on one of the pages. The top diagram is also on one of the pages of our presentation. And I've put a red circle around the All Ords Accumulation Index. The All Ords Accumulation Index is up 6.4% or 6.5% over the last 8 years and is up around 6% per annum over the last 10 years. Now, as I've been going around the country in the last 2 weeks presenting to different groups of people, I've been telling people that that is an unacceptable rate of return for equities. For the amount of risk involved in investing in the equity class, to earn 6.5% per annum on your money gross per annum for 8 years is a very, very low rate of return. Why is that? It includes the second worst stock market crash this century and significant periods of volatility. We hope and expect that the All Ordinaries Index over the next 10 years will deliver equity-style returns of 10 to 12% per annum. And our job, should that arise, is to then try and outperform the All Ordinaries Accumulation Index. As we go through this presentation, the one thing I'm trying to distill in people is that this is not an index-hugging fund. This is not designed to replicate the All Ordinaries Index. In fact, so many of the regulatory changes that are occurring in Australia at the moment are around trying to cut the costs associated with index hugging. That $900 billion to $1 trillion of money that's managed for superannuants in Australia to an index hugging mandate is not what we're doing. Following on from the amount of gross performance that we deliver, we then charge a management fee, and on that, and then that net performance number we pay tax on. That's how a company works. There's been a lot of questions in the last 2 weeks about how you reconcile our share price to our performance. The big number there is tax. If you gave us $1 10 years ago and we've turned that into $4, we've made $3 profit. Well, we've paid $1 away of that in tax. The biggest expense in this fund is tax. So we then show this on our newsletters to help people try and reconcile the fact that your biggest expense in this fund is tax, and that those dividends paid out of 50 cents have another 20 cents of tax paid on them, and inside the $1.47 of pre-tax NTA at the moment, or $1.44.5 of post-tax NTA, tax has been paid on that too. So we then hope to pay out 7 to 8% fully franked yield per annum. Reversing that, in order to pay out 7 to 8% fully franked dividend yield, and given that we're not financially engineering our company or paying out fully franked dividends and then borrowing money from the bank to pay those out, we have to earn 10 or 11% per annum, pay the tax on that money, and then we can pay you 7 to 8% fully franked yield per annum. Our goal is to earn 15 to 20% per annum. That was our long-term goal when we set up this business 10 years ago, and we will continue to endeavour to do that. That's really what the business has been set up to do. Just quickly, the stocks that have been performing for us, and we'll come back to those in quite a bit of detail. The ANZ Bank, BlueScope, an iron ore play, Bravura Solutions, Flexi Group, Macquarie Group, Macmillan Shakespeare, QBE, RHG Limited. A lot of interest rate sensitive stocks in that. If I bundle those together, interest rate sensitive stocks have been doing well. In an interest rate falling environment, assets go up in value. That's a great time to own those style of stocks. Stocks that have done poorly for us in the year just gone, Arium, Bathurst and Coffee. My mining services, I think I spoke about entering mining services last year. I bought 3 stocks. We got stopped out of all of them. It was a disaster. So, I lost 0.15% of the fund's money 3 times. So I lost nearly 0.5% of our performance last year just in buying 3 mining services. You definitely don't want to be in mining services at the moment. Well, you might now, but definitely not then. Chris will talk about Arium. Arium had been a poor performer and has been an excellent performer for us this year. And if we broke that down in sectors, there's the banks, diversified financial services, commercial professional services have done very well for us, and materials, resources that they've done particularly poorly. And just this slide here, which was in our presentation last year, we've just finessed it slightly to try and make it more legible. That's what we're trying to do. When the market's collapsing, we don't want to be invested, and when it recovers, we want to be invested. We have an open mandate that moves between equities and cash, and the open mandate also allows us to buy cheap stocks and sell or short expensive stocks. Again, most of the $900 billion of superannuant money managed in Australia is not allowed to do that. They're given a mandate to be 100% long, and if the market's collapsing, they've got to be 100% long. And they're given a mandate to be in resources, and if resources booms over, they've still got to be long. They're given a mandate to be index hugged, they've got to be 25% banks. And when the banks finally do collapse, they're going to still have to be 25% long the banks. This is not an index hugging fund. We are allowed to vary our exposure to equities, and in that way, we manage our risk. In addition to all the traditional ways that a portfolio manager can manage risk, the additional tool we have is we can move to cash. Oh, so RHG update that many of you may have seen in the webcast or in some of the recent correspondence. Now, Chris has just come back. Amazing that RHG and CDM are having their AGMs at exactly the same time on exactly the same day. So we sent Chris down to the AGM, but he came back pretty quickly. Was it over in half an hour, Chris?
20 minutes.
20 minutes. Oh, okay.
So it's quick.
Geez, what are we doing wrong? All right, so RHG, many of you would know, has been our largest position. It's a position we scaled into. We took a 1% position at 18 cents, added to it 4 times like we do. So it became a 5% position at cost. And since then has been what Peter Lynch would call a 9-bagger. It's gone up 9 times in value. Some of the criticism around that was you guys have let that grow to quite a big position. We let our profits run and we cut our losses. That is true. Modern portfolio theory would say you have 20 stocks each with 5% in them and you've diversified away 80% of risk. The problem with that theory is a 5% position that doubles is a 10% position. And again, I'll hark back to that $900 billion of superannuant money. If you did that with their money inside a traditional fund, you let a position become 10% of their portfolio, you'd lose your job. It's that simple. You'd have concentration risk, stock risk, sector risk. You'd have all sorts of... There'd be all sorts of reasons why you would instantly lose your job. And job protection is the most important thing in that scenario. So people would simply not do it. You wouldn't let your profits run and cut your losses. What you are allowed to do in a big house like that is cut your losses, cut your winners and add to your losses. So we don't do that. So just to make it clear how this all ends up. I mean, it all sounds very rational, you know, the modern portfolio theory. But when you're cutting your winners and adding to your losses, that's an insane world. And unfortunately, that's a world that many people find themselves in now. Unknowingly, I would say. So back to RHG, we let our profits run. We've had 2 problems along the way. One is a gentleman called John Kinghorn tried to privatise this company at 88 cents a few years ago. And we, along with a whole group of other fund managers, stopped that process. We called an extraordinary general meeting and we all voted against that. And since that date, it's paid out $1.21.5 of dividends. When you include franking, it's $1.74 of dividends. And that was the first problem. We got over that hurdle. The next one was that a group called Resimac Amac came along and offered 38.5 cents equivalent to today for the shares, and the board said, yep, that sounds pretty good. And we didn't know if it was pretty good. If the board said it was pretty good, that sounds good. But what I don't like doing, if I was to sell a house or a motor car or anything, I always like to have a little bit of competitive pricing tension, a little bit of an auction. Many people here would see that often houses are sold on auction. The idea there is to try and get the highest price. Stocks is no different. You should try and get the highest price. So we went along and we knew Pepper. Pepper had spoke to us. We knew they liked these assets. And we went and saw them and said, and asked them if they still like the assets. They said, we love these assets. Pepper's the largest non-bank home loan originator in Australia. And they said, we can't bid for these assets because we need to know that we would get 100% of the equity in RHG in order to finance the book. I said, listen, if you join up with us, you've got surety under a scheme that you will succeed. And they said, yes, we'll do that. And so then a bidding war ensued, or what I call a price discovery process. And that went along 38.5, 41, 44.5, 46, 47.5, 48, 48.5, 49.5, 50. And then the big one, 50.1. And that just sent, Pepper just said, no more. That's too high a price. We're not getting the internal rates of return we require on the $2.2 billion book. We're out. So we became, in legal terms, what's called disassociated at that stage. So that the highest bid on the table now is 50.1 cents of cash per share. And everyone's going to vote on that on the 18th of December. So what are the positives about this story? The positives are we've made another $38 million for RSG shareholders. The positives are for our shareholders in this fund, as you sit here, we've made you another $8.5 million. The positives are that's been good performance for us. The negatives are this has weighed heavily on our share price. There's been a lot of uncertainty around what we're doing here. There's been some shareholders. I had a shareholder ring me up saying, why are you guys getting into mortgages when you're supposed to be invested in shares? Right? And this is the kind of thing that happens. So we were never getting into mortgages. We were bidding for the book on behalf of Pepper, and Pepper were always going to be the owner of this. And so that 10 to 15% premium that we've been trading at and worked so hard at getting to over the last 2 to 3 years has disappeared. We're actually trading at a slight discount to NTA at the moment. We think that, there's the short, the medium, and the long term, and things will restore themselves to normality. And from the 18th of December, I don't know if any of you have had a chance to read that scheme booklet. It's a heavy one. It's 150 pages. I was just skimming through it last night. And but the things that are important for all of us are that the votes on the 18th, if it goes through, the syndicate have committed to getting us our cash, the 50.1 cents, 5 business days after the 8th of January next year, or as soon as practical after that date. So that's where RHG is at the moment. I'll take questions afterwards on RHG because there have been a lot of questions. The prospectus, and people would have just started receiving this. Why are these two related? We've got a lot of emails and telephone calls from RHG shareholders saying, "Hey, Cadence, we like what you've done here. This price discovery process has made us a lot more money." But the negative of it is that we might have been able to get shares in Cadence, and under this scheme, there's no opportunity to get shares. So we've done a prospectus given these RHG shareholders a priority. We would never give RHG a shareholder priority unless we gave our own shareholders a priority. So our shareholders and RHG shareholders have a priority in this placement. And there's a broker firm component to this as well. When we struck the price for this prospectus 2 weeks ago, I think, our pre-tax NTA was $1.43. It's since gone up, and we've made an announcement that it went up to $1.47. So, and the board has announced a 1-for-1 bonus option issue expiring on the 31st of August 2015. Now, that bonus option issue, you have to be on the register on the 15th of January next year in order to get that. So if people are selling their shares now, they're not going to get the option. And we put an estimate out on that day that the option value was somewhere between 7.5 and 11.5 cents. You can never know what a market's going to do and how these options are going to trade, but that's theoretically what the value of them is going to be. The resolution for this transaction is at our AGM at History House, which will be on the 3rd of December. 6th of December. So it's next Friday. And we'll come back to questions on that too. These are the key dates for the transaction. The broker firm came in yesterday. There's a few stragglers. 3 people haven't come in with their bids yet, but it's fair to say that the placement is going extremely well. And we are seeing a different style of investor appearing on our register, and I will talk about that. It's one of these slides. So very quickly, our investment philosophy. The March quarter webcast goes into this in some great detail, so I'm just going to go through this quickly. These next 4 slides have been in our presentations for 10 years. We use a combination of fundamental and technical analysis to make investments, not one or the other on their own. We're not that style of house that has an academic argument with each other about which one's better than the other. If you've got 2 things to use instead of one, you use them both. We're competing against the overall market. We're not competing against each other. We visit companies on a daily basis to identify undervalued or overvalued stocks, and we use an adaptation of William O'Neill's CAN-SLIM analysis. Many of you would have heard this before. We use price to earnings growth ratios, we use free cash flow, operating cash flow, and balance sheet strength to determine whether a company is even worth investing in the first place, or worth, and on the other hand, if it's really overvalued, whether we can short it. And we have very detailed entry and exit strategies. Here's a graphical representation of Australia. There's 2,250 companies in Australia. 700 of them made a profit last year. Actually, it's slightly down on that. It's just under 700. So about 1,600 companies in this country you can't even analyse on the stock exchange because they don't make money. Of the ones that make money, 90% of them are truly average. Lots of different businesses, bit of debt, bit of cash, a little bit of operating cash flow, a little bit of free cash flow. We don't spend a lot of time in that middle area. We're looking for things that are cheap, the 5% that are cheap and the 5% that are expensive. And we say here we visit 300 to 400 companies per year. Since Simon's joined us, the combination of Chris, myself and Simon, we're visiting nearly 500 companies a year, and we expect that'll probably go to 600 companies a year. People say that's a lot of companies. There's 3 of us. There's 220 business days in a year. If we each visit 1 company a day, and it's actually a bit of fun. If you like visiting companies and talking to management and talking about other people that have got businesses, I mean, we're building a business. They're all building their businesses. It's actually it's kind of a fun job. So what are we trying to do here? We're trying to buy low and sell high. We usually have no problems with this slide. People are, we buy low, sell high, buy low, sell high, sell high, buy low. The problem is, though, that everyone says they're doing this. And if everyone's doing this, why isn't everyone outperforming the All Ordinaries Index? And we think there's a little bit more to it. First of all, an open mandate. Most people don't have an open mandate, so they're not actually doing this. And the second thing is that the way that you enter and exit positions has a big bearing on how you make money. We're not allowed to buy stocks even if we like them if they're falling in value. And we're not allowed to short stocks even if they're expensive when they're going up. I would have loved to short Xero at $7. When it hit $1 billion market cap, I was tantalizingly close to shorting it. But of course, as Wayne pointed out to me, I'm not allowed to short a stock that's going up. Well, it's $34 now, I think, and now has a $4 billion market cap and is now the second largest stock in New Zealand. And guess what? Those index huggers, they've got to make it the second biggest position in their portfolios. They have to. So they're now paying $4 billion market cap for a company with no earnings, that have never produced any cash flow, that has 40% of the valuation of Intuit, the world's largest accounting software and technology company, and has spent $200 million on getting it to where it is today. I'm not saying Xero's a bad company, right? Don't get me wrong. I'm just saying at $4 billion valuation, looks a little bit stretched to me. So what do? We're allowed to buy into something. When RHG goes from $2 to $2.40 on the float, then collapsed to 7 cents, and is announced on Wall Street Journal as the worst stock market float in the world during the global financial crisis. It recovered from 7 cents to 18 cents. We looked at it. There was 28 cents of cash in the bank, and it was trading on a PE of 0.5. Okay, so we bought 1%. Then we added to the position, and you know the rest of the story. Reckon, when we floated at $1, went to $4, collapsed to 8 cents. We had a look at it at 15 cents. It had 12 cents of cash in the bank, and it just earned 3 cents for the year. So it's on 1 times cash flow. We added to the position. It's been a 20-bagger. And this is kind of what we do. This is what we're set up to do. And when we get out of things, we scale out of them a third, a third, a third. How did we get out of resources? We scaled out of it a third, a third, a third. Nobody rang us and told us the resource boom was over. Right? All that started happening was the share price started going down of all the resource companies. So we sold it a third, a third, a third. This is all monitored on the Cadence dashboard. It's our own proprietary system. We spend a lot of time on it, and we're evolving it all the time. So our shareholders, I just wanted to give 2 little slides here on what's happening. Approximately 55 to 60% of our shareholders are now self-managed super funds. That number just seems to be going up and up and up, or self-directed investors. They're coming to us directly, they're getting to know us directly, and we try to communicate with them directly. Our shareholders have grown from 1,000 to 3,000. We expect that number to exceed 4,000 this year. And over 10 years, we've seen the self-managed super fund industry grow. I was just discussing this with a shareholder before the meeting, from $25 billion to $500 billion. This is not a trivial exercise here. The $1.7 trillion of superannuation money that's going to be in the system the year after next is bigger than the entire market capitalisation of Australia. This money has to be very, very carefully managed. And as the government's beginning to realise, we have to have some very careful thought processes about how it's going to be managed. The process of going around and saying, oh, this fund has a lower MER than the other, or this has a lower MER than the other, is not the solution. I could tell you a company has a $5 million of costs and another one has $10 million of costs. You still know nothing about the company. You need to know the revenue of that company, less the cost, to work out what the profitability of that business is. So I feel that the superannuation industry is in its very early stages of evolution, and over the next 10 to 15 to 20 years is going to have to become a lot more sophisticated. When we went around 10 years ago telling people we were raising money and we were not going to hug the index, we couldn't get meetings, right? So that you either were index hugging or had an information ratio or Sharpe ratio that matched something close to the index, or you couldn't get a meeting. That has changed significantly over the last 10 years. And in the next 10 years, when people realise that the alpha is not generated in the index but outside the index, the industry will look different. We think it'll look different. CDMs has seen a large number of self-managed super funds in drawdown mode. We in our AGMs and when we talk to people on the phone, a lot of people 60, 65, 65 plus, we've seen that our shareholder base has looked like that. We're noticing a lot of younger people now. People are starting to take control of their own destiny at a much younger age because they're beginning to realise the consequences of owning a self-managed super fund with your returns compounding at 15% tax. And the numbers can be startling when you start to put them through a spreadsheet. And the difference between earning 6% per annum and 16% per annum when you're compounding it and putting $25,000 a year into a self-managed super fund is enormous. Our fund growth. We have an open mandate to match our investment philosophy. I've probably bored people to death with our investment philosophy, but that's what's required. We require an open mandate. We measure our performance against an index. The only reason we do that, we need to measure it against something, but we are not index hugger, and we're not trying to replicate the index. That's not what we're trying to do. We strive to outperform the market, not replicate it. And we're looking for under-researched or mispriced stocks. That's our job every day. That's what we're trying to do, to construct a portfolio designed to outperform the index, not match the index. And we are the largest shareholders in this fund, and our aim is to achieve these objectives with conservative risk-adjusted parameters. This isn't a free call option. You're not talking to a guy here who who charges you a management fee and a performance fee, and then invests all the money on black, and it comes off, and I earn a big performance fee, and if it all goes to red and everyone loses money, I just go to my next job. Yeah, we're the largest shareholders in this fund. The free call optionality associated with this industry, after the global financial crisis, you would have read about extensively all around the world, and probably creates the biggest conflict of interest in the whole industry. Our open mandate does currently cover overseas equities, which over time may help us generate performance. We have not invested in overseas stocks to date, and it will improve liquidity if we were to do it and could enhance risk-adjusted returns. We haven't gone there at the moment, but what I'm trying to explain to people is that as we grow, you shouldn't expect to see us just replicating the index and buying more and more. What tends to happen as a fund manager grows is they all start out looking for good and bad stocks on the edges of the curve, and then as you get bigger, they start to go more and more and more and more into the bulk or ordinary shares. We're trying not to do that. And so the summary of those two things, the two worlds are: self-managed super fund is growing. More and more people are taking responsibility for their own financial destiny. They're finding us. They come to us direct. They're not coming to us through 10 or 15 intermediaries that are charging them another 2.2%. They're coming direct, like most people here are. And on the other side of the equation, it's our job to go out and find those things that are going to generate a return greater than the index, not the index. So how do we see the year ahead? Well, our approach, I hope I've managed to convey that our approach remains unchanged. We're going to continue doing what we're doing. You're not going to see us come out with a different style of fund, for example. We're not going to suddenly be a long bias, long short manager and then bring out a long only top 100 fund or a all resources fund it's just not how we manage money. So we're not going to come out with a different style of fund. We're going to continue doing exactly what we do. We're looking for stock-specific and industry-specific opportunities, which always present. And the other thing, of course, that we can say is the macro environment remains uncertain, and there's a lot of ambiguity in the marketplace. I remember when people used to worry about $2 trillion of debt in the American system. No one seems concerned about the $20 trillion of debt in the system at the moment. I'm hearing stories that, people are worried about the amount of debt paper that America's writing on a monthly basis. Japan's writing a little bit more. So, the environment's changed significantly and is extremely uncertain. But what we think is that index tracking and replicating the index in this environment, when you've got high volatility and very low return, is not the right strategy. And we know that 3 or 4 years ago, 5 years, we were told exchange-traded funds became extremely popular. They became extremely popular at exactly the time that volatility came along and there was no returns. And so, of course, people move into the wrong asset class at exactly the wrong time. That's what happens. That has to happen. Otherwise, you can't there's no opportunity to outperform. But we are optimistic, as I've already said, that the 10 years ahead should deliver more than 6.5% All Ordinaries Accumulation Index return. Maybe that's a big call, but it's really just a call based on history. We're expecting that 10 to 11% return that an equities market should deliver you in order for you to participate. And we've earned a tea or coffee out the front. Thanks very much, everyone. Thank you.
That was literally in prison.